Welcome back, everyone. Welcome back to my channel. It is me, the Millennial Investor, 1914. Holla at your boy. The more you do the videos, the more you get comfortable, the more you just gotta rock with it, right? So this video is about basically that generational wealth, the generational wealth. Uh, I want to end this. So my net worth currently right now is at 150 7,000, right? So what you see right here is that this 141,000 right here is for my investment portfolios that's on Fidelity, and then I have my 401k with Vanguard, and this is just liquid assets. It's not taking account my house or uh, and we're not even taking account just investing into crypto, right? This is stocks, and this is just right here on my Fidelity account. But the goal is, as we sit down for 2026, I want you guys to get in the mind of me. I am a planner. I organize my life. I organize my bills. I organize. Got to know what's coming in and what's going out. And for 2026, I want to show you guys my investing strategy for 2026 and how I'm breaking down to get to this bag. Get to this bag. I got to this. I got to the bag this year that I had with my sign-on bonus. I had broke my sign-on bonus into 6 months, and I was just double tagging my account from the front and from the back. I was contributing 1250 and had 350 from the sign-on bonus putting together. Boom, 1500 a month. 15. At some point, I was paying, I think, 2000. I was hitting my taxable account 2000, 2000, 2000. Especially last year around April, April when the market had really tanked. I think I had put around March or April. I had put my bonus from my company into the market in March. I had put like a sign on bonus in April, and then I had some extra money, and I think I had put like 2,000, 2,500, whatever. Call it what you want, like call it uh catching a knife, right? I was definitely catching a knife on that. It was definitely crazy. But the goal is how I'm going to contribute and make that generational wealth. I'm not going to hold you. We're going to go into detail. Uh, so, boom. Here's the screen. Here's the screen. Here's the screen. So for 2026, this is how I plan on investing. What we have is we have multiple. I have multiple ways on how I want to think of this. So there's two ways how I want to think of this. There's option one and option two. So option one, I'm going to contribute 1,050 per month, which at the end of the year, that finally going to be 1,050 will be roughly 12,500, 12,600 for the year, right? I know for a fact that I want to buy more Oracle, Meta, MPLX, Aflac, Google, SP 500, TSM, Exxon, Oracle, and JP Morgan Chase, right? But the goal is that I could go down that route, or I can start a new position in land research. So if you know what land research is a semiconductor company that the semiconductors are. It's one of those semiconductor companies that actually make the chips and whatnot, just like ASML. It's similar to that, right? Very highly volatile. At some point, a lot of times it be up a lot, it go down a lot, go up a lot. Has a lot of its revenue that deal with China. So anything in regards to bad news or good news with China will affect this company. But at the same time, I also invest into TSMC, and that has a lot of heavy influence with uh, the global economy in China, et cetera, right? Also, what I have is that I have here QQQI or SPYI. These are cover calls that I want to add to my portfolio so that I can have my portfolio make more money. My portfolio, I want to create the the money machine. The money machine is basically when you can create your portfolio. Not only would your portfolio grow based upon total return or grow based upon the assets, underlying assets of your portfolio growing, like Broadcom, Meta, and Google, right? But also want to orchestrate my portfolio so that I'm not just only relying on the portfolio growing. I want to also have my portfolio pay me dividends, whether it's monthly, quarterly basis, and I also want the money of the dividends to grow, right? That's dividend growth stocks, dividend growth companies like Aflac and Kroger and JP Morgan Chase. Not only are these companies growing, not only these companies paying a dividend, but they pay a growing dividend. Kroger tend to grow their dividend roughly 10% per year. Aflac the last 2 to 3 years have grown their dividend over 10%, and JP Morgan Chase on average 7.5, 8% per year. When you sit down for your raise and for your merit increase, you'll be lucky if you got 3%, 2%. You barely lucky if you get a cost of living increase. But these dividend stocks tend to increase their dividend more than what you get in terms of a cost of living, or more would you get in regards to a merit increase. That's crazy, right? But this is how you play the game. And so compared to this investment strategy for 2026, I'm leaning on more so this investment strategy. And if I don't plan on opening up a new position in land research, I plan on just basically invest to the rest of these stocks, but invest pretty much this and that together, or about maybe $400 or $450 into QQQI, and man, that's going to be a delightful thing to see. If you know, you know. If you know, you know. And if you don't know, you don't know. But yes, I am trying to get to this bag. I'm trying to get this money, and I'm trying to double down, and so I can reach my goal. So I can retire by 50 years old, 45 the earliest, 50 years old the latest, because we're not getting any younger, and as we get older our body is deteriorating, and definitely this is my goal and my thought process of how I make money and how I sit down right here and basically use this uh, my Excel spreadsheets to figure out uh, what I need in terms of how I'm going to break it down how I'm going to break it down to actually make more money and to increase my net worth. The way you increase your net worth is basically revenue minus expenses, or your paycheck minus your expenses. You either decrease your expenses or increase the more you make with side hustles or raises, or you do both. You increase your top line by making a little bit more money, decrease your bottom line, decrease your expenses you pay, your bills, don't add any more bills, and use that surplus and invest into stocks. And in the meantime, the third component of the cake of increasing your net worth is basically time. And real quick, for me, I know you guys are looking like wonder where does the generational wealth come in that? So with my net worth of 155,000, so year 30 is right now. That's at 37. In 3 years, let's say that I'll have a net worth of 281,000. This is liquid. That has nothing to do with my house. So 27, no, 37, 38, 39, 40, 281,000. Then 5 years from that, which will put it at year 8. That is at 45 years old. I'm hoping to have a net worth of my liquid assets of between 760,000, 750,000 to 850,000. And then if you add just 5 more years, I'm hoping to have a net worth of at least 1.5 million. So we'll see. This is just using the compound interest calculator, and for the most part, this is just to show you right here that I'm along the way. I am living below my means. I am investing heavily. I'm investing 20 to 25% of my income, sometimes more, because I'm trying to put more in with time so that I can so I can retire. Because with AI, around the corner, people losing their jobs, uh, the robots come in. I, I if I need to get little, get skinny, and have to basically sell everything and move to somewhere and downsize, I can, and I would have the assets to live off of. I honestly only really need at least 500 to 550,000, and I can make that stretch for a lifetime and live off of and have it grow. So anything above 550,000, if something bad happens, I'm peacing out. So make sure you like and subscribe. This is my goal if we're investing in 2026. And then also in the long run for that generational wealth, I'm alongside. And I think I'm going to lean towards investing to SPY for next year. And I might start a new position in land research. I might. So make sure you like and subscribe. Rock with me, and I'm out. Peace.